So once again, welcome to Kingdom Wealth Creators, and today we're going to talk about stop losses. Okay, so what is a stop loss? Now, again, if you remember the sessions we've done before, a stop loss is basically where people would try to minimize their loss by setting in an automatic exit point. Okay, so you enter a trade, whether you're going long or short, you enter a trade. Immediately after you enter a trade, you also put an exit point where you are trying to minimize your loss, and you can also put an exit point at your target one also. Okay, and so stop loss is basically to minimize loss, and I think this is something that a lot of people make mistakes in. A lot of things that they do as a mistake is: one, they don't put a stop loss; two, they put a stop loss too close to where they bought it. Some people ask, can we buy it, and then put a stop loss right where we bought it. Hello, I don't know of a lot of shares which have just gone straight up the moment you bought it. Any of the shares, most of the shares that I buy, there is a phase when it actually goes below the price I bought it at. So I can tell you, if I put the stop loss there, it is going to go up. And then it's going to go up the way I wanted it to, and it's going to make money, but I'm not part of it because I've already exited. So those are the two mistakes I think most people. One, either they forget to put a stop loss. Two, they put a stop loss too close. Three is they arbitrarily decide the stop loss based on, I will always put it 2 rupees below. Whether it's a 10,000 rupee share or a 1 rupee share, which is impossible, but a 10 rupee share, they'll put 2 rupees below, which is not actually a good principle. And I will talk to you about this. Okay, so stop losses. Let's look at what a few things. Now, someone that I have been following is a person called Bruce Kovner. He's a very well established fund manager, and he has some thoughts to share with us. Okay, he says, whenever I enter into a position, whether any entry I make, I always have a predetermined stop. What does that mean? The moment I'm entering a position, a trade, I already know what is my stop. What is my stop loss? Predetermined. Okay, because I know if I'm going to enter here, this is my stop loss. Okay. Second, he said, I know where I'm going to get out even before I get in. And this is very important for me also. Yeah. Normally, when I see a potential trade, one of the things that I look for is if the stop loss is going to be too high, I'm not going to enter the trade. So where I'm getting out determines if I'm going to get in even. So I want you to know that there are many trades that I see. Sometimes I don't take them simply because I realize the gap between the entry point and my potential stop loss is too high. That's too high a risk for the reward that I can potentially get. So I know where I'm going to get out before I get in. Third, the position size on a trade is based on the stop. Now, this is another mistake people make. Okay, so for example, if I were to say I have 1 lakh to invest, so I always invest 1 lakh in every trade. That's not a bad thing, but my actual question is, what's my risk that I'm willing to take? That is going to decide how many shares I buy or sell. It is not how much I can buy or sell based on the money that I have, but my risk will decide how much I buy or sell. Okay, let me give you an example. For example, say I'm buying. Okay, here's an example then. Okay, if my stop loss is 10 rupees, for example, I'm trying to enter into a trade, and I realize my stop loss is 10 rupees, and I'm willing to only risk 50 rupees. What is my position size, or how many shares should I buy? So if my stop loss is 10 rupees and my risk, I'm only willing to risk 50 rupees, my position size is 5 shares. Whether I'm buying or selling is a different, whatever is my entry thing, the position size is 5. So let me repeat that. So if my stop loss is 10 rupees and my risk is 50, my position share is 5 shares. Okay. Let me give you a real life example. Suppose I am getting into SBI. So yesterday I got into SBI. I got in at about 160.50, 160.60, something like that. And I realized my stop loss is 2 rupees, roughly 2 rupees. Okay. So when I realize my stop loss is 2 rupees, I can decide what is my risk that I'm willing to take. So my risk actually is about 2,000 to 3,000 rupees risk. Okay. I sometimes it goes between 1,000 to 3,000. Okay. But I also looked at what is the timing. This was at about, I think about 2:30 in the afternoon, and the market for intraday closes at 3:15 or 3:20. And so I realized that is also an added risk, the time factor. And so what I did is I bought 300 shares of SBI. My risk is only 600 rupees, But that is because I was factoring in the time. But if it was normal 2000 rupees risk, I would buy how many shares of SBI? I'd buy 1000 shares of SBI. Okay. Now again, do I have the capital to buy 1000 shares? Probably yes. If I do, I can buy it. If I don't, no point buying it. But it is actually based on my risk. If my stop loss is 2 rupees and my risk appetite is say 1000 rupees, I will buy 500 shares or I will sell 500 shares depending on whether I'm shorting or going long. Okay, so that is the answer there. Your stop loss and your risk decides how many shares you get involved in a trade, position size. Okay. Now the stop is determined on a technical basis, which means you don't put the stop loss simply because you feel like, okay, I'll put it 10 rupees below, I'll put it 5 rupees below. No, no, no. You actually determine it on a technical basis, and I will explain this uh, more in detail. But this is what Bruce Corner also says. Okay, this guy is really good. He is one of the best, well-established, fund managers in the world, and he's saying, stop loss is determined on a technical basis, not simply because I feel like I should put it here. Okay. Then he also says I always place my stop loss beyond some technical barrier, which means there are some things that the price has to break through before it takes my stop loss. Okay, so my stop loss is precious. I can't simply throw it away, and so I'm going to put it in such a way that the price and the stop loss has some sort of resistance or restrictions or barriers in between. Okay, and I'll explain this to you. Okay, and so I place my stop loss at a point that is too difficult to reach easily. That's what in the first example I said. If you have a share, you bought it at say 160, and you put the stop loss at 159.90. I can tell you with almost 100% surety that stop loss is going to hit 160 and 159.90. Definitely going to hit, because most of the shares that I bought or sold, I've seen it goes beyond, it breaks a little above or below the price, and then only it goes down the trend that I'm looking at. Very rarely do I see I buy a share and immediately it just goes up. It doesn't. Okay. So we got to make sure that our stop loss is not put in a place where we'll just take it off. So what happens here? Suppose I buy it at 160 and I'm thinking it's going to go long, and I put my stop loss at 159. The share, it'll come down, hit my 159, and then it'll go to 170. So what happens? My planning was right, 160, target 170. 10 rupees I can make. But I put my stop loss at 1 rupee, it comes, takes it down, and suddenly it goes back to it goes to 170. So other people who got into the trade, they made 10 rupees. I made a 1 rupee loss. Where I could have made a 10 rupee profit, I made a 1 rupee loss. Simply because I put my stop loss in a place where the market can say, hey, come with me and take it and go. Okay. So a lot of people make this mistake where they put the stop loss too close, and I make the mistake too, especially when I do trailing stop losses. Okay, I make that mistake often. But the stop loss has to be based on some technical aspects. Okay, so let's look at this. Now, another thing I told you, the first problem that people always do is they forget to put a stop loss. As soon as you enter, place a good stop loss. Okay, and this is something that a good trader said. I don't know. I won't specify his name. As soon as you enter, place a stop loss. That is point number one. Place a stop loss. It should be automatic. The moment you buy or sell any share, the next thing you do is put a stop loss. Okay. Protect your stop loss behind some technical barriers, which are like a trend line. Now, I use a lot of trend lines. I'll show this to you. So for me, one of those barriers is the trend line that it actually crossed. Second, moving average. I usually buy the share only after it cuts the moving average. And so a moving average is also a technical barrier. And of course, resistance and supports. Okay. And this again, a good trader told us. I won't specify who that is. Okay. And then never place the stop loss at the barrier. So people do this also. Say it cuts the moving average. It cuts the moving average at 159, and now it's at 160. And so you will say, oh, it'll come towards the moving average, but it'll never cut the moving average. And so I will put it at 159. It'll come, take it and go. Now, why is this happening? It's simply because a lot of the large investment, brokers, the banks, the mutual funds, they all track the trend lines and the moving average. If you think that we are ustads at it or we're really good at it, I want you to know they are 100 times better than us. So what happens? If they know that this is a barrier and they are going in the opposite direction as us, okay, for example, I'm thinking the share is going to go down, so I shorted, and then I put the stop loss at my average. There are some investment institutions which have probably gone long at that same time. Now for them, or they might have gone long earlier. Now for them, they want to make it to, and they have huge number of shares, right? If we are trading 100 shares, they're trading 1 lakh shares. Now imagine, if so, they right now the price is at 158. Okay, we sold at 159. Stop loss is at 160. The average is at 160, and right now the price is at 158. Imagine if they suddenly sell off all their shares. The market is going to go down just like that, right? I'll also make money. But for them, that might not be a lot of money. So what they'll do, they know that a lot of people have probably shorted this share and their stop losses were sitting around 160. So they will start buying to come to 160 where they can exit. So if they have 1 lakh shares and they buy 100,000 shares, 10,000 shares to bring it to 160, what happens at 160? There's a lot of people who have made stop loss buy, right? Lots of orders pending there. They at that point there's a lot of buying pressure. They will certainly sell their 1 lakh shares, no problem. Everybody buys. Even me, I bought with my stop loss. Suddenly, I sold at 159. I bought my stop loss at 160, and I made a loss. And the big guy, the big smart money fund trader, investment banker, he's bought the price from 158 to 160. He's exited 1 lakh shares. He's made profit, huge profit. So the point is never put the stop loss at the barrier, but beyond it. Okay. Don't put the stop loss at the obvious level. Again, some people would put above the barrier, but they'll put it in such a way it's very close to the barrier. It's like hugging the barrier. What happens again? Sometimes the same principle that we discussed before, the fund traders and the investment managers, they will buy, and it will cut the barrier. It will come up to a little level higher, and then they sell off. And by that time, it takes my stop loss. So I'll always give it some breathing space. I'll explain to you with examples. Okay. But these are just my thoughts. And never place a stop loss at the barrier, but beyond it. Okay. So now, how do we do this practically? Sarjan, you talked about all of this, but how do we do this practically? Let me explain. One, the 4 things that I would look at is one, the trend line, moving average, market structure, average true range. Now, all of these don't work all the time. Okay. I will show you with examples, but I will look for, these are the 4 things that I look at when I make a decision on where to put a stop. Okay. Now let's look at an example. Okay, let's look at SBIN. So this was a trade that I did yesterday. So SBIN I bought at 160.70 and I exited at 161.75, 300 shares. Okay. So when we bought it at 160.70, I knew where my stop loss was. So this is the share price. Okay, this was the market yesterday. So look at this. Why did I buy? Why did I enter? Okay, I entered because one, it cut a trend line. Okay, it cut the trend line at 160 here. So it cut the trend line. Okay, MACD is going green. It has already gone above the average. Okay, all of that is a good factor. But the reason why I bought it was trend line. Now, so that was the entry price. Somewhere here was 160.70. Question: where would I put my stop loss? Okay, so I bought it at 160.70. Where would I put my stop loss? If I put it now, some people will say, why don't you put it just below at 160? I want you to see if I put it at 160, there were 2 candles where it went below 160. In fact, after we bought it, it went to 159.90, 159.80 or so in between. I can tell you for sure that stop loss would have gone, and I would have lost that money. Okay. So then where would I can put it below the trend line. So for example, I can put it below this blue trend line. And that's not a bad thing. Sometimes that is a good idea. But looking at this, where I put my stop loss, I put it here. So this was 2 rupees below. Okay. Why did I put it here? Because the ATR is saying 0.98. So you can put it safely here, no? Yes, you can. But just to be sure, I put the stop loss here. Why? Because there are 4 factors here that are working for me. One, 160.70 trend line is, acting as a barrier. Second, the moving average is acting as a barrier. Third, the average true range is acting as a barrier. All 3 barriers, but there's something called a market structure. If you look at this, there's this whole bunch of candles which was, you can see so many times there was a resistance or support that picked up, and so this at about 159 there's a lot of resistance or support. Okay, at 159 there's a lot of support, and so I put my that's a market structure basically support there, and so I put my stop loss below it. For this share to come down and take this stop loss, it has to go through a lot of hard work. Okay, and so that's my decision factor. Now, if this market structure was down here, and then I had to put my stop loss here, this 156, 4 rupees difference, I probably would never enter the share. But because it was 2 rupees difference, I was willing to enter the share. Okay, you see that? Okay, now let's look at another one. So we did Bajaj Finance. So now Bajaj Finance was a different story. Bajaj Finance, look at this. Okay, this there is no market structure per se here. How will we decide? And there was no trend line cutting over here. There's no trend line there. Okay, so and I got in at 1938 when it cut the trend line. And it cut the trend line, I bought it at 1938. Sorry, when it cut the moving average, I bought it at 1938. But before I bought it, my question was, where would I put the stop loss? Because there's no market structure here. You can see the market just came from here and it's just going up. Ding, 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 ding. This is going up. One speed, one F1 racer going just up. So where would I put my stop loss? Should I put it just below the line, moving average? Which in fact, in this case, didn't turn out to, if I put it, not a bad decision. But there is a possibility that it might have gone bad. Okay. So then I looked at the ATR. The ATR was saying roughly 15. Okay. So for safety's sake, I also looked at what was the previous candles. So you see this candle, the candle before where I entered. I entered on this huge big candle. But the candle before that, its low point was somewhere around 124 or 123. And so for safety's sake, I decided I'm going to go with 120. That is 18 rupees below my buying price. Now 18 rupees is not a huge, because the share price is 1,900. Okay, there's another thing that I do. I always look at 1%. I'm willing to lose 1% of the share price, and that's my effective stop loss. Roughly, practically, I do this. If it's around 1% of the share price, that's a good stop loss. But obviously, I look at all the other factors also. But 18 rupees is roughly 1% of the share. So I'm willing to lose that. And so I put my stop loss here. I put it at 1920, which was below this candle, which was below the moving average, which was below the ATR, and also it was roughly 1% of the share price. Okay. So 4 factors why I put the stop loss there. Eventually it went to 1980. People made lots of money. I made money on the share yesterday. So this is another case. The first case when we talked about SBI, there was a clear market support there, right? And it cut a trend line. But in this share, in Bajaj Finance, there was no trend line. It was just a moving average cut. And there was no good market structure there. Safe market structure there. Oh, I can put it just below this. And so despite that, I made a very, you see how I did a technical decision on where to put the stop loss. Now, what if the stop loss was supposed to be 40 rupees below? I would say if that is my risk appetite, if I'm willing to lose 2%, then maybe 40 rupees makes sense to me. It would be a good stop loss for, say, if I'm holding it for a month. But for intraday, probably not a good decision. Okay. So if that was the case, I wouldn't enter it. Or I would enter smaller quantities. For example, over here, I'm willing to lose. So when I bought 100 shares of this, right, I was willing to lose 2,000 rupees. If the stop loss was 40, I would only get 50 shares. You see that? So because I'm willing to lose 2,000 rupees. So I put 100 shares, stop loss 20, 2,000 rupees. The stop loss was 40, I'd get into 50 shares, 50 into 40, 2,000 rupees. So that decides how much shares I buy also. All right. But actually, I wouldn't probably get into such a trading position in the first place, because that 2% or 40 rupees, when I look at all the other factors, is too big a stop loss. I probably wouldn't get it. Okay. Because if you looked at this thing, you can see that this red candle, it closed at 1,900. So I could say, hey, this should be your stop loss. Actually, that's dumb, because you have lots of price rejection here. So this was a good price rejection. So it probably won't come down here. So a better stop loss is 1920. Again, market structure a bit, uh, decision making, but this was the reason why I picked 1920, and obviously it went and made a profit. But let me look at something very difficult. Okay, look, let's look at Hindu liver. Okay, Hindu liver, Hindustan liver was yes, Emmanuel, that's correct. Okay, so let's look at now. Those were easy ones, right? Let's look at a difficult one, and this was Hindustan lever. This was on 28th. Like I said, this was a very iffy trade that I got into. I got in. Why did I get it? Okay, so Hindustan lever. You can see this. This is the red candle, green candle that I got it. Hindustan lever cut the price at about 2002, which is where I got it. 2004. I got in at 2004. So the moment I got in, I was already calculating my stop loss. So the ATR is saying 9. There is a bit of a support here. You can see that this market support here. Okay, this is market support here, and the stop loss is actually probably going to be somewhere here, right? Right. Now, most people would put their stop loss just below the trend line. Oh, look at the trend line. It cut trend line. So let me put my stop loss here. Okay, they put it at 2000. This fellow came all the way down to 1098. 1998. If I had put my stop loss here, it would have gone. But what I did was I put my stop loss at somewhere around 1989, if I'm not mistaken. So that's a huge stop loss. Okay, that's about 14, 15 rupees. But I was willing to give 15 rupees. Obviously, by this time I saw the second candle, this guy, this share actually went to 2014 or 15 at that time. But when I saw the second candle, I knew I was in trouble. So what I did is I exited at 2010. Okay, so I got in at 2004. I exited at 2010. You know, I made a little bit of money on that, which is okay. But you can see how my stop loss decision was: look, below the trend line, below the market support, below the ATR, and below the moving average. So 4 reasons why. Now I want to say this is a iffy, a risky trade because the stop loss is actually larger than 1%. Almost. Okay, not fully, but the stop loss that I was intending for this was larger than what my criteria was. I felt this was a very long stop loss. Actually, it was not larger than 1%. 2000, you could have gone in at 19802. That's fine. But I realized that the return that I was looking at, I got 6 rupees, right? So I was putting a 15 rupees stop loss for 6 rupees return. Because when I exited, I realized, oh, this is going to be a problematic thing. I should get out. Okay. And so I felt this was a very iffy trade. Nothing wrong with where I put the stop loss because the support is there, trend line is there, the moving average is there, the candle. Look at this. This the lowest point. I've taken this candle, this candle, this candle, and this candle, and I put it below that. For it to break through all of it, it has to go through all this price rejection. But again, I didn't feel this was a great trade. Most people have put their stop loss here, and it would have gone for sure. Okay, so this would have helped. In fact, if I had held on to the share like this, okay, with this stop loss, I probably would have, and if I had held on to the share for the next 1 or 2 days, it actually went to 2030 between. It would have made me around 30 rupees. Okay, if I had held on to the share with this stop loss. So you see, the stop loss is very powerful. Where you put the stop loss makes a whole lot of difference. Okay, so let's just look once more at what are the decision factors that we decide on. One is the trend line. Second is the moving average. Third is the market structure. Fourth is the average true range. And fifth, I think, for me, practically is this rough 1% rule. Okay, most of the trades I take is 1% rule. I will try to gain 1%. I'm willing to lose 1%. And that, of course, it is not just the 1% that decides it. I will look at the stop loss situation. For example, for Hindu liver, when we look at Hindu liver, if my 1% means I would have put the stop loss down here, 1980, right? But because I saw the moving average, the trend line, the moving average, and the support structure here, and the ATR was only saying 9, I went with the 15 rupee stop loss. I could have gone with 20, which is what I was willing to lose. I exited out, which is why I'm saying this is an iffy trade. But your stop loss doesn't have to be rigidly always 1%. I'm just trying to make that a point, okay? Here it was less than 1%. In SBI, if you look at SBI, in SBI, the stop loss was more than 1%, because you're buying the share at 160. Your stop loss is almost 2 rupees. That is like 1.25%. The stop loss is 1.25% below. Again, that decision is actually driven by all of this plus the 1%. Okay, so the trend line cutting, the moving average cutting, the ATR value, the sub market structure, all of this decide where my stop loss is. And I want you to know something. The stop loss is what makes me decide whether I get into a trade or not. If I'm not willing to risk this much on any trade, I will not get into that trade. It is as simple as that. Many people, I want you to know, many people make a mistake. They say, you know what, I'm willing to risk. So when they buy it, they say, oh, what is the stop loss? That question itself, if they don't know what the stop loss is ahead of time and they're deciding what is the stop loss after they get in, that's an issue. Okay, because they don't know how much they're willing to risk. What happens when they do that? When they buy or sell, or when they get into enter into a trade without predetermining where the stop loss is going to be, what is the issue? First, they will either overexpose or they won't buy enough. Okay, two things. One is the actual potential value of the trade goes down or up. Is because you don't know the stop loss. For example, some people who buy, say their investment is 1 lakh, okay, 1 lakh, but the stop loss here is 3%. So they are going to, their normal risk is 1%, 1,000 rupees. The stop loss potential here is 3%. So that is 3,000 rupees. So what they should do at that time, even if they have an investment of 1 lakh, is they should reduce the size of the trade by one third, or reduce it to 33%, to 1/3 of the actual size they normally take. For example, let's say I normally buy 300 shares of BPCL, but today my risk is 3%. I will only buy 100 shares. Okay, so getting into a trade with how many shares I have to buy, what price I have to buy, is all actually based on the stop loss, which is another reason why normally I don't enter into a trade if the share price is way above any trend line or moving average, because I got to put the stop loss behind some technical barrier. No? I can't go put it in the air somewhere. Like, just keep it there somewhere. No, I have to put it behind or beyond some technical barrier. And if the share price is very far from any technical barrier, I'm in trouble. Okay. And so that's basically the reason why I make that decision. But as to what price, a lot of the trades I see a lot of trades every day. I want you to know that I see a lot of trades every day. I don't get into everything. Every day on the trading market, I would see about 100 to 200 potential trades. Okay, you know how many trades I get into? Maybe 5, maybe 7, sometimes 3, sometimes 1, sometimes 0. And the deciding factor often is, of course, there are other factors also to decide, whether it's a clean break, whether it's a trend line cut. But one of the key deciding factors is, where will I put my stop? What is my risk? What is my risk appetite? What is the stop loss? That will decide. And where is the share price compared to all the trend line or the moving average? And then I will decide if I want to enter the trade with how many shares should I buy or sell. Always. If I fail that criteria and that test and that requirement, I am in potential possibility of making a severe loss. That even after that loss, even if I get other shares profitable, it might not work. I will still come at an overall loss for the day. So I think this is important as a trader. And it's not just intraday. Okay, you got to look at everything, long term, short term. All of this has actually stop losses. Stop loss is not just for intraday trading. Sometimes I've seen so for me, when I've seen a share that I'm holding cut below the MACD line or cut below the moving average, I'm holding the share. I will sell it. I will sell it because I know that day it's probably going down. I will look as it cut the moving average on a larger time scale, like a 1 day moving average. Has it cut the one day technical chart moving average? If so, I'm going to sell it. I don't want to hold it because I know that it's going to go down. Keeping the share at that point is a danger. You need to know when to cut losses. You also need to know when to book profits. That's another story. But I think the first story that we got to make sure is how to cut or minimize our losses by the regular, proper, consistent application of a stop